Hey everyone, let's talk about the Medicare Part B premiums for 2023. Now, at this point, the standard premium amount has already been announced and it's old news, but there are certain situations where this premium can increase drastically. If you don't know the rules, these premium increases can take you by surprise and hit hard. So today, I want to go over how this works and tell you how, under certain circumstances, you can appeal the higher premiums and get the additional surcharge removed. Now, I know a lot of people who have already retired and they're counting down the days until they hit 65 so they can come off of their expensive plan where they're paying $1,000 or more and get on Medicare. This is something that we see fairly often in the retirement roadmap plans that we build. Once someone goes on Medicare, the cost of health care drops tremendously typically. And that's considering that they're paying the cost of the standard premium for Part B, Part D, drug care program, and a supplement policy. Now, the other thing that drops are their taxes because now they're not having to pull out as much in taxable income to meet that gross income need and pay for that expensive health care. So Medicare is really a cheap form of health insurance for most people. Now, the reason it's so cheap is that you paid for it through your working life through payroll taxes. And in return for those payroll taxes, the federal government will typically pay for most of the premium. So when it's time to go on Medicare, you only have to pay a percentage of the Part B premiums, and the federal government picks up the rest. Now, the percentage you have to pay could be higher under certain conditions, but before we dive into the increases that can happen, let's talk about the pricing of Part B Medicare and how they determine what the annual premium is, because this is really the foundation of how premium increases will be applied. By law, the premiums for Part B have to cover 25% of the cost that will be incurred by that part of the program. So every year, the Centers for Medicare and Medicaid Services have to estimate the annual cost to pay for all of the services covered by Part B. Then they set the premium to 25% of this cost. This 25 to 75 ratio, where you pay 25% of the cost and the federal government pays 75% of the cost, it's what the vast majority of those on Medicare are paying. But if your income increases beyond certain thresholds, that ratio starts to change and you have to pay a higher percentage of the program cost, and the federal government pays less. Now, this ratio can change all the way from where you only pay 25% of the cost to where you pay 85% of the cost. So Medicare can be as expensive as private health insurance if your income goes over certain thresholds. And you need to pay careful attention to these thresholds because they're what we refer to as cliff brackets, which means that if you go over by even $1 or really even 1 cent, you're subject to the higher premium that comes with it. Now, they refer to this as the IRMAA, which stands for the Income-Related Monthly Adjustment Amount. And just a quick note here, the number they use for your income is your modified adjusted gross income, which for Medicare purposes is your adjusted gross income plus tax-exempt interest. Most of the government programs have different methods to calculate the modified adjusted gross income, but thankfully this version is fairly straightforward. Now, I know that in most of the discussions about the IRMAA, most people focus on the premiums for Part B, but what some people forget is that if the IRMAA applies, they'll also get an increase to their Part D prescription drug program. The reason that Part B gets all the attention is that it's the highest in terms of dollars. This is the part of Medicare that covers doctor's visits, lab work, physical therapy, surgeries, and quite a bit more in that group as well. The standard premium for Part B in 2023 is $164.90. That's a decrease from 2022. But again, this can go higher, and there are 6 income thresholds with each having a progressively higher percentage share of the program cost. So to illustrate this, I'll use the 2023 thresholds for a couple who are married filing jointly. And if you want to see the full threshold table, just download my retirement planning cheat sheet, and I'll put a link down in the description. Now, if you are at or under $194,000, you pay the standard 25% of the program cost, and the federal government pays the remaining 75%. That's just the standard premium. But if your income goes over $194,000, you'll pay 35% of the program cost. If you go over $246,000, you'll pay 50% of the cost. Over $306,000, you'll pay 65%. And then over $366,000, you'll pay 80%. And if you go over $750,000, you're going to pay 85% of the cost. Now, I know that using percentages like that certainly isn't all that enlightening, but I wanted to show you the rationale behind the premium increases. But let's put this into dollars and see how this works. The first thing to know is that they use your income from 2 years prior. So for example, your 2023 Part B and D premiums would be determined by looking at your 2021 tax return. This is because they make this determination in late 2022, and 2021 would be the latest return that they have on file. Now, I'll talk about some of the challenges this presents in just a moment, but just know the income we're referencing for the 2023 premiums are based on your modified adjusted gross income from 2021. If you're under the first threshold amount, your Part B premium is $164.90, and there are no additional premiums added to your Part D. But if your income falls in the second threshold, your Part B will increase to $230.80, and you'll have $12.20 added to your Part D premium. In the third threshold, your Part B premium will increase to $329.70, and you'll have $31.50 added to your Part D premium. In the fourth threshold, your Part B will increase to $428.60, and you'll have $50.70 added to your Part D premium. In the fifth threshold, your Part B will increase to $527.50, and you'll have $70 added to your Part D premium. And then in the sixth and final threshold, your Part B will increase to $560.50, and you'll have $76.40 added to your Part D premium. And an important note here, if you're a couple who is married filing jointly, that's the premium that you would each have to pay. So you don't have to look at those numbers for long to see that Medicare premiums can get really expensive. So it's important to avoid tripping into these accidentally. So how can you plan around them? Well, because of the way they're set up, it's not always easy. These thresholds change on an annual basis in response to inflation. At least most of the brackets do. The last threshold won't actually be changed for inflation until 2028, but all of the others, the ones underneath that, are all set to increase right along with inflation. Now, that brings about some planning challenges when trying to guess what the brackets will be in 2 years. So for example, let's assume you get to the end of 2023 and you want to take an additional distribution from your IRA, but you don't want to trigger the higher premiums for 2025. So how do you know what that threshold amount's going to be in 2025? You don't, and thus the planning challenge. So my suggestion is just to use the brackets that are in place this year. That may be overly conservative, but keep in mind, this is a cliff bracket. You really don't want to be over one of the thresholds by just a few dollars unless you are aware in advance that you will be over. Because I'll tell you, receiving one of those initial determination letters from Medicare, especially when you're not expecting one, is not very pleasant at all. Now, none of that means that the IRMAA should always be avoided at all costs. There are some reasons that you may voluntarily subject yourself to higher premiums. For example, if you're doing Roth conversions and you have a large IRA balance that you're converting, it may be difficult to avoid the IRMAA. But the IRMAA should always be calculated in as part of the overall cost to convert. So what happens if you get one of these letters in the mail saying that you're going to be subject to the IRMAA? Well, first, don't automatically assume that you have to pay the higher premium. It may be possible to appeal and ask Medicare for a reconsideration. The Social Security Administration has a specific form they want you to use to request this, and on this form, it lists the specific reasons they will consider reducing your premium. And further down in the form, on page 5, I think, they even give some examples of these reasons. One of the reasons that I see people appealing to higher premiums is work reduction or work stoppage. If you were working and earning a high income, but then retired or had your work reduced enough to lower you down into the income thresholds, you can appeal, and most of those appeals that I've seen have been granted. Ultimately, navigating higher Medicare premiums is something that a lot of retirees are going to have to plan around. This is yet another reason why I think it's critical to get a written income plan, ideally before you retire, but at least within the first few years of retirement. The cost of being inefficient with how you take your retirement income can extend beyond just the cost of increased federal taxes. It can also get into the IRMAA, and collectively, those things can really drive up the cost of being inefficient. If If you want some help with your own plan, there's a link down in the description where you can get started with me and my team. Thanks for watching.